Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member.
There's not a single formula for this. Either someone who's taken a small amount of money and turned it into a huge amount of money, and to take two extreme examples in the current book, two of the traders have literally gone from sub $50,000 accounts to close to $500 million. That's sort of a dramatic but real example of what I mean by a spectacular increase in wealth, right? Then the other one is traders who just haven't made like a ton of money, really, but they've had an unbelievable return to risk. So two other traders in this book, one of them has not had a losing month, but it's like steady. He doesn't make a fortune. He basically earns a living as a trader. So he's like...
So when Jack and I met, we had this firm belief that there were some amazing traders out there globally. And along the path, we realized that it was one thing to find a talented trader, but if they were in a country where maybe they didn't have a regulatory jurisdiction or they didn't have the legal structure set up, they couldn't really properly, have the institutional infrastructure to manage outside capital. And so it became almost another barrier to entry for them to transition from a really good trader who's really focused to then aspiring to become the Stephen Cohen of the world, that they actually launch a fund in managing capital. The idea of the accelerator, and it was, how do we find that talented trader, let's say the market wizard quality trader, and then come around them and provide them with the infrastructure, the mentorship. It could be regulatory, it could be marketing, the distribution, the access to capital, so that they can be focused at what they're doing, and then we can provide them with all the needed resources for them to potentially manage money and then compete against some of the largest hedge funds in the world. Perhaps somebody who's listening to the show who's aspiring, they want to manage money, but also they're risk averse and intelligent enough to know that they're not going to spend a lot of capital setting up a structure of a fund to potentially raise money from outside investors that they have no network from, right? And so this is almost like legging into this opportunity.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Oh, yes. We're on episode 308 of the Chat with Traders podcast, and this is a special one. I'm Tessa Dow, co-host with Ian Cox, and we're joined by Jack Schwager, best known as the author of the legendary Market Wizards series and also co-founder of FundSeeder, together with his partner and fellow co-founder, Emanuel Balarie. We dig into what it actually takes to be considered for a Market Wizards book. There isn't one formula, but Jack definitely looks for standout performance. Traders who've achieved the kind of results most would think impossible, but it's not impossible. Over the years, we've had traders who were featured in Market Wizards that eventually appeared on our podcast. But as Jack described the qualities he looks for now, I couldn't help but think I wouldn't be surprised if some of our other guests that we've had on the show who've never been in the books before might show up in a future volume. That's an exciting thought, and we shall wait and see. One of the parts of our conversation that stood out to me as a developing trader was the razor's edge between surviving and blowing up, and why it so often comes down to position sizing and planning your exit in advance. From there, the conversation branches into the kind of obsession with process and routines that Jack has consistently seen in the traders featured in his Market Wizards books, an obsession that allows them to keep adapting as markets change. We also talk about whether timeless strategies like trend following can still hold up in today's markets, and a surprising paradox Jack points out about fundamentals and risk that might change the way you think. Then we shift to FundSeeder, a platform co-founded by Emanuel and Jack, built to discover and evaluate undiscovered trading talent from around the world. Emanuel explains how it works, how they verify performance, evaluate capacity and process, and how through the FundSeeder Rise Accelerator, now part of RQSI, a hedge fund and seeding firm with a long track record of backing emerging managers, they help top performers get the infrastructure and seed capital to scale. And here's the part that should excite many of you listening. They're actively searching for the next generation of talented traders, people with the potential to move from trading their own accounts to managing outside capital as professional fund managers. Very few will ultimately make the cut, but every great manager starts somewhere. And if you've been honing your craft and building a real track record, why not you? So if you're serious about your craft, you'll love this episode. More information and links are in the show notes. So without further ado, ladies and gentlemen, we are so pleased to present Jack Schwager and Emanuel Balarie.
Well, everyone, I'd like to welcome both famous Jack Schwager, author of the Market Wizards books, and Emanuel Balarie, who is the founder of FundSeeder with Jack. I'd like to start off with Jack. Jack, welcome back to Jack with Traders. I think it's been 7 or 8 years since you were last on here.
Yeah, it's been a number of years. I'm not sure how many.
Yeah. And you're up. You've written a lot of great books, part of the Market Wizards series of books. Are you up to, how many has it been? 6 already?
I'm working on number 6.
Oh, you're working on number 6. Okay, great. I read your first Market Wizards book back in 1994, and that inspired me to get into trading. Do you have a release date for your book?
The release date is, I think it's going to be around June.
Yeah, looking forward to it.
Maybe
So
July. I don't remember the exact date, but it's early summer.
Okay. Do you have all the slots taken up? You found all the traders?
Well, we've done all the interviews. The actual confirmed list of who's going to be in the book haven't officially confirmed that yet. So just waiting until the book is actually finalized in manuscript before I kind of describe, go into more detail on it.
And could you share with us kind of what are the criteria to get entrance into your books?
Yeah. Okay. So obviously the first criteria is performance, and then the question is what kind of performance? And there's not a single formula for this. So basically I look for one or two things. Either someone who's taken a small amount of money and turned it into a huge amount of money. And to take 2 extreme examples in the current book, 2 of the traders have literally gone from sub $50,000 accounts to close to $500 million. $500 million, yeah.
Oh, God.
Right, or 500 million if we went around it to millions. So you can't get, that's sort of a dramatic but real example of what I mean by a spectacular increase in wealth, right? Then the other one is traders who just haven't made like a ton of money, really. I mean, made X millions, whatever it is, but they've had an unbelievable return to risk. So 2 other traders in this book, one of them has not had a losing month in 11 years now that can be shown because he went off on his own, but then he was a prop trader. And I don't doubt him when he says he didn't lose money in those, prior few years as well. So he's probably gone 15 years without a losing month, without a single losing month. So, but it's like steady. He doesn't make a fortune. He basically earns a living as a trader. So he's like making about, I don't know, $300,000, $400,000 a year, sort of makes money every month. But that type of consistency, another trader who's had a long track record was able to track back further. I forget how many years now. It was over 15, but In his case, he's had 5 losing months, all pretty small. In the first case, you can't even calculate some return risk ratios because you get infinity because you have no divisor that's negative, right? But you get, and in the second trade, it was a few losing months. You get these extraordinary return risk numbers that are just mind-boggling. So it's either of those two as far as the performance side. And then there are other criteria in terms of that. It can't be for a short period because anybody can have a good 5 years, right, or whatever. I typically try to get a minimum of 10. In many cases, it's 15 or 20, or even the official track record, as is the case in this book as well. Sometimes can't go all the way back because they were prop traders before, but they've traded for a long time. So I'm getting people who've demonstrated it for lengths of time. Very rarely will I make an exception to the 10-year rule. Occasionally, for some compelling story, but it's always at least close to 10 and 95+ % of the time. It's well more than that.
Wow. Yeah, those are outrageous returns. In some of your previous interviews, you've mentioned that you were looking for the truths of the markets that will still be true 100 years from now. And you brought up the challenges of human nature as one of the key sticking points and how human nature works against us. And you referenced a funny image of monkeys throwing darts at a Wall Street page often do better than humans. And my question is, could these results be dramatically improved by just position sizing appropriately for each person's psychology?
Well, yes. I mean, position sizing is an important element, and it is a downfall of many traders. There's a amount of cutting losses, in terms of risk management, right? Amount of cutting losses, and then there's a matter of position sizing. So if you size too large, you can cut your losses, but if you're going to be risking 10% of your capital on any given trade, and here, let me be clear, I don't mean that you buy a stock that takes up 10% of your capital. That is not, that's only risking 10% of your capital if you're holding it to zero, right? But I'm talking about you have a plan, you have either a stop in or a plan or some defined risk point. So you may be 10% of your AUM, but you're only risking 1 or 2%. So that's fine. So the mistake if people put on a position too large, and then it can become a very damaging, one bad trade can become very, very damaging. In fact, a number of the traders in this new book, as great as they are, as spectacular as they are, had some hair-raising episodes where position sizing was part of the problem.
People, before they get into trading and they have their jobs, they can treat their job seriously and know that they have to study and work hard and follow rules. So why do you think many new traders can't treat trading like a job? I mean, they've got their skin in, they got a lot of skin in the game, their own money, and hopefully avoid most of the pitfalls of human nature that has plagued us from the beginning days.
The reason is because I think probably the majority, and I don't know how large of a majority of people who get into trading, don't appreciate that to really succeed, and you can see this again in this new book. I keep on thinking, when I'm answering these questions, there's so many glaring examples to prove this, where these people trading wasn't just a hobby, it wasn't just wasn't even a job. It was an overwhelming obsession, and just kind of capitalizing all their time and energy. And the fellow I mentioned who never had a losing month, he literally gets up at 3:30 to check the markets, goes back to sleep, and then comes back at 5:30, and then doesn't wind up until 8 p.m. So, wow. That's the kind of devotion that you get, and types of intense analysis and study that some of these traders do. One fellow just they're talking about going through thousands of cases, SEC filings, and just becoming almost a walking encyclopedia and categorizing it. SEC filing comes out, figuring out what's important, what happened in each case, what's not important. It just, the amount of work that they devote to this is sometimes staggering. And one of the other traders, basically, not only with the trading, it was a prop trader trading. He no longer, now that he's made a fair amount of money, he's kind of eased off a bit. But in his early part of his career, when he was a prop trader, he would not only spend the entire day trading, he'd do the analysis afterwards, but he would literally record key parts of his trading and then replay them and retrade those things out of market hours. So that's the kind of devotion. Now, you think about people who get into trading because they want to be a trader and they want to make money. They don't have that type of devotion, with exceptions, but for the most part, they don't. And I think that people don't appreciate to really excel. I mean, you have to have a talent for it too. That's another element. But even if you have the talent, you really have to do the hard work.
Mm-hmm. The hard work as in just investing time or learning everything there is to learn about it? Because you mentioned the guy that looked at SEC filings and...
Well, the hard work, first of all, you have to define what your strategy is and that it's what you want to do and what you feel you have an edge at. But then it's just doing everything you can to hone that strategy. And it goes beyond that. It's not like learning a craft. You're a carpenter and you learn every technique and you get really better and better and you get to a certain point and that's it. And now you know how to do everything, any type of cabinetry and do it perfectly. And you devoted your life to being a perfect carpenter. In trading, it's worse than that. I mean, because you get to a point where you're skilled and everything's going fine, but markets keep on changing. And in almost every case, I can't think of a single interview in this book where the trader didn't go through adaptation phases and change. And sometimes where they end up could be quite different from where they started. So it's not only a matter of devoting all this time and energy to whatever the technique is at the moment, but it's also a matter of being open to the need and the signals that particular methodology is losing its efficacy, and you now need to adapt into some other strategy. One of the trader I mentioned who had only 5 losing months and very high return risk, who, by the way, is himself, he runs a prop trading firm he co-founded, and he estimates he's trained over 200 people in his day, traders in his day. But he emphasizes that the importance of always maintaining the mentality of a trainee. In other words, even though he's got 25 years of trading experience, even though he's trained 200 traders, he still keeps himself at the mentality where he's like a trainee who's just trying to get in, trying to break in, and trying to find stuff that works. And so he tries to keep himself in that framework because he knows that whatever's working today, in many cases, won't be working a year from now or 5 years from now, whatever. So he tries to always be looking for new techniques or how his current methods have to change.
I see. So it's almost like he's trying to anticipate the next change in market behavior. Like if he was learning how to trade when the market was in a strong trending bull market and then the market goes choppy sideways for a while. Is that kind of it? He's trying to anticipate different market conditions and learn ahead of time?
It's more a matter of in his case, trying to find different patterns or quirks or inefficiencies in the market. And he gives examples in the interview where, for example, at one time, the idea of figuring out which stocks were going into the index, let's call it the S&P or any other index, and which were coming out, trying to anticipate that and be long the ones that are going in and short the ones that are going to come out, that was a great strategy for an edge, because once it goes in, all these institutions have to rebalance their portfolio. So new stock comes into the S&P, it's going to get a lot of buy. I mean, it's an obvious thing. So for a few years that worked, but then it became too well known and armed away, and it's no longer works. And these things disappear for sometimes explainable reasons, and sometimes for reasons which are a mystery. He mentions he had this, that he used to trade the VIX. He had a particular pattern he traded in the VIX, and it depended on the time of day. And it was like a really reliable pattern. It was an important strategy of his. And then for some reason, and he couldn't explain it, but when Russia invaded Ukraine, right after that, the pattern stopped working and never worked again. So some of these things, God knows what the relationship would be between the invasion and the VIX, but maybe it's just coincidental. But the point is, things that work very often will stop working. And sometimes they may come back, but sometimes never.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit, and move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more, all in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. How much of that do you think is attributed to other traders hearing about it, and then that particular strategy gets crowded? And have you found any particular strategies or ideas that maybe worked for a while and then were discovered, or didn't work for a while but then forgotten, and then later came back into vogue, almost like an old style of fashion clothing or something like that?
Yeah, well, maybe the best example is trend following, right? So back when I did the first Market Wizards book, and this is so I'm interviewing people. I'm interviewing them in '88, but we're talking about careers which go back, in their cases, to the 60s, or at least the 70s, right? And so back in the 60s and 70s, there's no computer. Forget about supercomputers, forget about quant shops. You didn't even have a PC, really, until into the 80s, which is the beginning of it. So the people like Ed Sekoda, who was in that first book, who was just doing simple trend following stuff. And I think his background was an engineer, and he got a job on Wall Street so he could use the mainframes and I knew exactly what he was talking about, because when I was in my senior year in college, I remember doing programming on the same mainframe as an IBM 360. Took up a good part of a small room, and it was punch cards, and it had the power. I don't know what fraction of an iPhone power it had, whatever. Anyway, but in those days, that's all. So he just needed access to the computer, and he did some basic trend following things, and he did phenomenally well on that. And also, like somebody like Dennis is a classic example, who used trend following to build a fortune. And that all worked great in the 60s, 70s, particularly the 70s, even into the 80s. But beginning then as computers became more popular and platforms and software became available, it's sort of everybody and their brother could do trend following, right? So it became too accessible, too easy, too popular. And the concept of trend following does have real rationale behind it. And that is because for many, many markets, once a trend begins, there are very good reasons for it to continue. So, if the Fed changes its policy, rarely does the Fed change from tightening to loosening, and then 3 months later go back to tightening. So typically, once they begin on a course of tightening and loosening, it often will just continue for a long time. In terms of currency valuation, central banks trying to control their currency values they decide or make an agreement to go in a given direction, like the Plaza Accord as an example, but once that happens, it tends to go for years. It just, so there are real reasons why, and you take commodities, you get surpluses, and then it takes a long time for that surplus to kind of work its way down. And then eventually you get to the point where it discourages expansion of production and whatever. So I mean, true for something like a copper, it takes a year. If copper goes into surplus and you discourage new mining and you discourage, and some old mines close and whatever, it takes a while, a very long time to open new mines if there's a shortage eventually. So there's reasons why trends exist. But what the market has done, I mean, I don't know who said it, but the market sort of fools the greatest, paraphrasing here. Will act in a way that will fool the greatest number of people the most time. So even though the trend will still occur, it will occur in such a way that it will cut to pieces some trend followers by just these whipsaw actions, which look like complete changes of trend. And not just minor pullbacks that, I got faked out by this pull. No, but these really big declines that and then the market may go right back. You see it more in stocks, by the way. You see in stocks, you get this extreme volatility like that because of earnings and things of that nature. But you get it in all markets. So it becomes more difficult to profit from trend following because of that whipsaw action becoming more pronounced. And I think I haven't ever done the analysis, and I don't know anybody who ever has. It would be an interesting analysis. But I would bet that if someone measured how prone the markets were to, let's say, reactions in a trend of beyond a certain percentage size, different thresholds, I will bet that has increased and become more frequent over time relative to what it was, say, in the 60s, 70s, and 80s.
You highlighted some of the examples of, say, fundamental factors that are behind a strong trend, because there's some good reasons why a trend is in place. In one of your previous interviews, you mentioned that fundamentals worked in contradiction to risk management. Why would that be?
Well, here's the crazy thing. So, if you, in technical, one advantage of technical analysis is that for most approaches in technical analysis, if you're wrong, it will indicate that your technical reason for being in the market is wrong, and it will tell you to get out if you follow your own approach. The trouble with fundamentals is, let's say I do an analysis of corn or whatever. Let's go market X, and let's say I say market X should be at $7, and it's currently at $5. Okay, so I've got my reason. This market, I've done the analysis based on supply and demand. I think it needs to go up because there's not enough supply to clear demand. At this price, so we need to bring demand down. Price has to go up. Okay, so that's fine. But then the market goes down to 450, let's say, for whatever reason. And let's say it doesn't change the fundamentals. So I'm sitting there. Well, if it was a good buy at 5, it's now a better buy at 450. And that's the key here, is that's consistent with the methodology. Okay, it's not like I'm ignoring my methodology. I've got my analysis, and my analysis tells me 7. Nothing has changed. The market is going from 5 to 450. So the only logical thing is not only to hold, but perhaps even to add. So that's the intrinsic nature of fundamentals is such that the more it goes against you, if nothing has changed in your analysis, the more you should add to the position. So that's what I meant. And that's what makes fundamental analysis difficult. And the other thing is that fundamental analysis is very poorly attuned, generally speaking, to timing. So there's not a consistency between fundamental. Now, sometimes you get a change, and Okay, so you get a change that some new information comes out and things change and the price changes. I mean, earnings reports in stocks are a good example. So surprise earnings report, okay, and the price adjusts. So sometimes it's obvious, which direction, but a lot of times broad fundamentals, there's no real timing to the shifting fundamentals and the actual price action. Sometimes the fundamentals precede, sometimes they lag. It can be all over the place. The only time, ironically, that fundamentals are good for timing, and this is just my opinion, is in a kind of contrarian way. So if the market gets some bullish news and it starts to go up as expected, and then declines and let's say closes lower on the day, that can be indicative of a change in, if the market has changed direction. So in that case, where the fundamentals don't do what you expect them to do, that might be useful timing. But that's ironically opposite to what the fundamentals said.
You've said multiple times in the past that one of the most important points is to know when you'll get out before you get in. Since most traders are used to setting their exits at 1R, 2R, 2 times what they risk, or 3 times what they risk, doesn't one run the risk of getting out too early and not capturing the trend is your friend and let your winners run, and those other aphorisms that has helped some traders make great profits off of a few trades that overcame many of their smaller losses?
Yeah, I mean, of course, this is just a general point. Obviously, if you're using any type of exit point for risk protection, you always, it's not theoretical. Traders who do that will get experience of being stopped out right before the market turns multiple times, and in their trading career, it's unavoidable. But the key is it also avoids any loss larger than what you're prepared, what you've decided to allow in the beginning. And that's a trade-off. And it's a trade-off which is necessary, in my opinion. And by the way, that line, know you get it, where you'll get out before you get in, that's, give credit where credit is due. That is a quote from Bruce Kovner in the First Market Wizards book. And it's the reason I like that quote so much and why I've used it so often is not only does it provide very effective risk management, the key there is that because it's the word before, because you're making a decision before you get in, you're making it at a point of objectivity. So it's different than if you stay with the position without any stop and the market starts going against you, and now you have to make decisions. But your decisions can always be clouded by the fact that you're in the position. That kills your subjectivity. So your objectivity. I'm sorry. So the idea of making that decision before you enter the position means you're making it from a rational, cool point based on what your approach is, and you say, okay, I'm buying the market at 50. If I'm right, it shouldn't go to 45, and that's where you put your stop. So you have a rational reason before you got into the trade when you were fully objective for picking that stop. And if it gets hit, well, that was your analysis that if it shouldn't go there, and if it did get there, you were wrong, even if it eventually rebounds and goes higher.
So let's transition a little bit about to the topic of FundSeeder and share with us how you got involved with that and kind of what was the inspiration, and also like to hear from Emanuel as well.
Sure. So I'll give my comment because Emanuel is the one who should talk mostly on this topic. But the idea was presented to me by Emanuel. At the time, I was doing some consulting for a firm that he was with, a brokerage firm, and we were at a conference together and having dinner, I believe. And he said, Jack, I want to pitch this idea to you. And he pitched the idea of FundSeeder. And I said, yeah, it's I'm one who's always prepared to shoot down ideas. Emanuel will tell you that. But I said, yeah, that's a good idea. And so that's why, so my only involvement was via Emanuel, who had the original idea.
Oh, great. So, Emanuel, I'd like to hear from you kind of a little bit about your background and then what made you get involved with FundSeeder or create it for that matter.
Yeah, well, Jack's humble. He was a true co-founder. There would be no FundSeeder without him. We were actually co-portfolio managers for a fund, and we were aligned in terms of believing that we could give capital to emerging managers. And we had traveled the world. We were in Portugal, all over, finding some of these emerging managers. And so, really, the reason for FundSeeder was where we wanted to have an edge to be able to discover undiscovered traders, undiscovered managers, and then somehow help them along the way in terms of becoming institutional or giving them capital. So our thesis was in a world, where, like Jack was talking about when he was, coding, in a mainframe computer, it had rapidly evolved where people had access now to information technology. But on the other side, the same big hedge fund managers were controlling a bulk of the assets. And so FundSeeder was looking to democratize how we can give access to talented traders from all over the globe, wherever they might be, and then provide them with analytics. And Jack was involved in this in terms of metrics that we could quantitatively evaluate. And then if we found the good ones, we'd give them capital. And so that was the idea behind FundSeeder.
Mm-hmm. So how does it work? How would you find these traders, or how would traders show you that hey, I'm a good trader?
Well, first of all, we're giving them a shot and an opportunity, right? So I think the last time I looked, we had signups to FundSeeder from over 120 countries. So no matter where you're at, you don't have to be in New York City, you don't have to be part in London. You can sign up to FundSeeder, and the idea would be you would be connecting your brokerage account. So we have connection with Interactive Brokers and adding others, or you can even upload your files, which we classify as unverified, and then we can see how you can, and you as well as a trader can see how you stack up against your peers, or you could stack up against others, and if you're really good enough or you're not good enough. And so that was the process, right? Providing, almost, if you think about the baseball analogy of a baseball farm system, opening it up to everybody and let the top 1% have an opportunity to potentially manage capital.
Have you been able to accumulate any stats on, what type of assets they trade? Are they systematic versus discretionary, or any information regarding number of trades, drawdowns, that kind of thing?
Yeah. So the analytics and, that FundSeeder provides, they look exactly what you mentioned in terms of drawdowns, gain of pain ratio, which, Jack is fond of, volatility, correlation to other markets. And so that gives us that initial sort of a viewpoint of, does the trader have skill or edge? And then, so that becomes something that is valuable to the traders who sign up to the platform.
Mm-hmm. Do you have any data on what percentage of traders can match or beat the S&P 500, or how many end up losing money or blowing up their accounts?
Well, I think Jack, when Jack and I started this, and it was initially just an idea, we always thought that the top 1% would even be good enough to potentially manage money. And so from a sourcing perspective, that's pretty accurate, right? Earlier in this podcast, Jack was talking about how, the top market wizards, are hardworking, extremely disciplined, are like almost, they're so focused on what they're doing, and that shows in terms of the data that we're seeing of the talented traders that have, top 1% in terms of risk adjusted numbers. We haven't looked at the ones who have, say, blown up or, how many of them churn through it, because our goal was really to find those top 1% that even before they sign up to FundSeeder had excellent metrics. And that's really the reason we even kind of were talking, as when we talked about the show. A lot of, I would imagine, a lot of the traders that are listening to your podcast are highly educated. They're always looking to learn from other traders. And you mentioned 3 of them that ended up are going to be in Jack's book. So that's really the profile of the traders we are looking to have sign up on FundSeeder.
Mm-hmm. Okay, so how do you evaluate traders from a quantitative and qualitative approach to get included in your in the finals?
Quantitatively, we're looking for managers and traders that have high risk adjusted numbers, whether so that filters it, return to risk levels. We're looking to see if their trading, their strategy has capacity. So if the trader could only, trade on $2 million, or they're trading small cap stocks or some type of short selling, that's probably not a fit for them to be able to transition to manage other people's capital, because the capacity is not there, and they probably wouldn't want to take on the additional capacity as well. So quantitatively, the data speaks for itself, but then qualitatively, when we have conversations, and Jack and I have had many over the years with these traders, we try to understand where their edge is at, right? And how can they articulate their strategy? What sets them apart from others that would say that they're doing exactly the same thing. So we look at the person, we look at how they articulate what they're doing, and then from a business perspective, and this is the point of transition from someone who's just trading their own money, do they have almost that business desire to scale and grow their business? And that becomes almost like a different evolution in their trading history, if you will.
Mm-hmm. I understand that you have an accelerator called FundSeeder. Is that or Emerging Wizards?
Yeah. So if you think about the genesis of really almost what we have done with FundSeeder. So when Jack and I met, we had this firm belief that there were some amazing traders out there globally. And along the path, we realized that it was one thing to find a talented trader, but if they were in a country where maybe they didn't have a regulatory jurisdiction, or they didn't have the legal structure set up, they couldn't really properly, have the institutional infrastructure to manage outside capital. And so it became almost another barrier to entry for them to transition from a really good trader who's really focused to then aspiring to become the Stephen Cohen of the world, that they actually launch a fund in managing capital. And so the idea of the accelerator, and it was, how do we find that talented trader, let's say the market wizard quality trader, and then come around them and provide them with the infrastructure, the mentorship. It could be regulatory, it could be marketing, the distribution, the access to capital, so that they can be focused at what they're doing, and then we can provide them with all the needed resources for them to potentially manage money and then compete against some of the largest hedge funds in the world. And so an example I would give is, if you're familiar with the Silicon Valley, where they had all these accelerators like Y Combinator, you had Airbnb or other companies where there were strong founders, they had some type of track record of success, but the network and the resources provided by some of these venture firms helped them accelerate where they became the massive companies that they are. And so we're trying to do the exact same thing for perhaps somebody who's listening to the show who's aspiring. They want to manage money, but also they're really they're risk averse and intelligent enough to know that they're not going to spend a lot of capital setting up a structure of a fund to potentially raise money from outside investors that they have no network from, right? And so this is almost like legging into this opportunity.
So just to confirm, so they're trading with their own capital and their own accounts, and their trades are verified.
Yeah. So for FundSeeder, we have two options. If they connect their brokerage accounts, their trades are verified, and if they're not part of a compatible, we don't have their broker is not compatible, they can upload an XLS file to use our analytics to see how they can compare, and then we can verify afterwards through statements or other means to make sure that their data is real and accurate.
Mm-hmm. How would you say, what are the differences of what you offer from the many online platforms that seem to be everywhere these days?
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So there's copy trading platforms, and I'm not sure if you're referring to those, where it's much more retail focused. You could piggyback on a retail trader and follow their trades. When we started FundSeeder, we always felt that, we're trying to find a handful of top traders and then help them become institutional so that they can compete against some of the bigger hedge funds out there. So we're more focused on the institutional investors versus retail investors that could kind of copy or piggyback on a trader that's making money, and then providing them with the infrastructure around it.
Tell us a little bit about RQSI. What is that?
Yeah. So as I mentioned, when Jack and I founded FundSeeder, we had this idea of finding talent, but we found out that it was much more difficult to transition from even just finding the talent to creating a scalable business. So RQSI acquired FundSeeder, and FundSeeder is part of RQSI. The founder, Neil Ramsey, was an early seeder in many managers. So he seeded, I think, just over 20 managers that went on to manage over $20 billion in PKUM. Some of your listeners might know some. Fort, QIM was early with Crable, and then he transitioned and built a stat arb model that went up to about over $2 billion. And I've known him for 5 or 6 years, and he's been working on a systematic global macro program, and the returns just stopped working. And when we reconnected, he said, "Look, I'm going to go back to my roots. I really believe that there are talented traders out there, and that we can help by giving first capital, providing seed capital to them, and not only that, but mentorship and whatever infrastructure that they might need, so that they have an opportunity to grow and scale." So this was a big piece of the puzzle in terms of the FundSeeder journey, because now you have capital that's being allocated, and you have a person like Neil Ramsey and RQSI that has actually a history of seeding some managers that have gone on to manage billions of dollars.
So your main focus for investors are institutional investors, correct?
Correct.
Okay. And then so then what's the main, since they have access to lots of, ETFs and fund managers, mutual funds and so forth, what's the selling point for them to invest with this group of kind of relatively new traders that are not nearly as well known as the people on Wall Street?
If you think about some of the largest funds out there, they're multi-pod shops, right? The Millenniums of the world, the 0.72s, the Citadels, and these firms are only allocating to the big established PMs, or you're hearing about the talent wars, and one manager moves from one firm to another. And so what we're trying to do is we're trying to create, this baseball farm system, if you will, of the smaller managers and giving them that first capital and providing them with the ability to scale and grow at a pace that makes sense. So from an investor perspective, if you're an investor and you believe in emerging managers, you believe in traders that have edge and they don't have to be working for some of the largest firms, that's something that makes this compelling.
Mm-hmm. So for all the traders out there, can you illustrate just a few benefits of signing up for your platform that they can get and perhaps maybe help improve their trading or the way they do things? How can an average trader benefit?
Yeah. Sure. There's two pieces. The first is if you're just a trader and you're looking to have some analytics, they're free that you currently don't have at your brokerage firm. You sign up to FundSeeder. Not only are you going to get these analytics, that you can see how your performance compares and some of these metrics we talked about earlier, but you could actually see how you can compare against other people in your peer group. So extremely valuable. Most traders that I know are trading in a silo. They have no idea how they stack up against their peers. Maybe monthly they see how the hedge fund index perform, but by and large, they don't have that comparison, and FundSeeder provides that. The second piece, and this is for the top 1%, and I'm hopeful that there's some of your listeners or even some that have been on this show that if they want to make that next step to manage money, that they apply to FundSeeder Rise, which is the accelerator. And this is a much more curated, exclusive program. And the traders that we do accept, we will work with them to help them scale and become institutional money managers.
Fantastic. Is there a cost to sign up?
No cost.
Okay, great. So to wrap up, how can our listeners reach both of you?
Jack?
Yeah, I do have on X. I sometimes am contributing on that. So just my name at Jack Schwager. I have my website, but I really don't update it anymore. There's some old stuff on there, which is jackschwager.com. And I guess I could be contacted through FundSeeder as well.
Fantastic. Emanuel?
Yeah, just go to fundseeder.com. And again, the accelerator, we're opening it up for another few weeks or so. So if you want to apply, or if you know someone, we would appreciate any referrals or recommendations of the next market wizards, if you will, that also have aspirations of being the next hedge fund manager.
Fantastic. Thank you very much for coming on Chat with Traders.
Thank you, Ian.
Thanks.
All right. I hope you enjoyed Ian's conversation with Jack and Emanuel. And I also had the great pleasure of chatting with both of them for a few minutes after the interview. While I think that the reality is that very few traders ever make the leap to managing outside capital, think about this. Every fund manager who did started out, like many of us at some point, trading their own account and steadily building their track record. I told them how appreciative I am on behalf of traders everywhere in the world for their contributions, bringing to us this amazing opportunity and possibility and giving us something to aim for. The great part, too, is that even if you don't make it into the accelerator, you can still sign up at fundseeder.com, FundSeeder.com for free to get analytics on your trading and see how you can stack up against other traders around the world. And that alone can be a powerful tool to help you improve in your trading journey. And if you have been honing your craft and building a strong track record, or maybe you're closer than you think, honestly, I know that some of you listening are ready right now for this next step. And I say go for it. We're rooting for you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.